We'll get going here. So I hope everyone's having a great afternoon, had a great day, and thank you very much for joining Mark and myself this afternoon. We got some quick introductions, and then we'll get underway right away. So my name is Alex Shanks. I'm a mortgage professional on Vancouver Island, and I've taken a big interest in helping seniors retire without missing out on the enjoyments of life that they all work so hard for. We see many things in this industry, and with the higher cost of living and inflation eating into many people's savings, they feel like they have no other options other than going to private or even just selling their home. My partner, Mark here, he's going to speak about himself a little bit, but then he's going to really deep dive into all the options on a reverse mortgage that it can provide you now and even for your family.
Thanks, Alex. Thanks for bringing me in today. I'm excited to be speaking to people. So, my name's Mark Phillips. I'm District Vice President for Home Equity Bank on Vancouver Island. I've been with the company for about 8 years, and prior to that, I was in the banking and investment industry for about another dozen years before that. So, I've seen all sorts of situations. And prior to coming to this company, I actually used to refer for my own position lots of the clients that we had who had a need, who wanted to stay in their home, who wanted to age in place, but couldn't get the help through the traditional, banking or investment channels. So this has been just a fantastic company to work for and a fantastic product, which again, I'm going to get into. Before I start the presentation, the one thing that I will say is my approach to doing this is never to try and sell anything to anybody. I would like to give you as honest and factual and opinion and information as I can, and then let you decide and ask questions, contact either of us. And if it's something that looks good for you, then please reach out, ask as many questions as you want. Don't play the high pressure sales game, because frankly, there's no need to. So I think we're going to start it off with a funny little video, and then we'll take a dive into the products.
Perfect. Yeah, exactly. I really like what you said there, Mark. We're same here. I'm not here to sell this on people. It's finding a solution for people to continue to enjoy their life. For some people, it's, hey, you don't even need to worry about this. But for a lot of other people, it is something you need to think about it. Mm-hmm. So let's watch this video here.
Here comes that agent, Terry with an eye. Probably going to ask if we're ready to sell again.
I got this.
Can I try?
Retire in the home you love with a CHIP reverse mortgage from Home Equity Bank.
That's one of my favorites. We've got a pretty good marketing department. They've come up with some great advertising. It's funny, but it's at the same time it's true, right? Everyone's always trying to convince retirement age Canadians that there's a plan for them and that they at some point need to downsize and move out of their home. And really, like I said, I've been doing this for 8 years with this company, and what I found is that people just don't want to move out of the homes that they love. And frankly, this is a product that helps empower people to stay in the homes that they love and age in place. And I think that's a great idea. So a little bit about who we are. So we're the company, we sell the CHIP reverse mortgage and a couple of other products. The name of the company is Home Equity Bank. It actually used to be called the Canadian Home Income Plan. In 2008, we became a Schedule I bank, or partway through 2008 into 2009, we became a Schedule I bank. And really what that means is more oversight, access to cheaper funds, so we can pass on lower rates than we used to clients, which is a good thing. We were recently purchased by Ontario Teachers Pension Plan, which is just, it's such a great partnership between two companies that both really have the same sort of goal to maintain the assets of retirement age Canadians. Well, in their case, Ontario teachers, but so that's been great. And they're a really useful company to be partnered with. And we actually are the only reverse mortgage provider in Canada who's exclusively focused on providing reverse mortgages. We have national partners with the CARP, which is the Canadian Association of Retired People, and the Royal Canadian Legion as well. So there are some member discounts and bonuses and things like that, but just a little bit about who we are. We we have about $6 billion in mortgages on the books, and we write about well, last year we did about a $1.5 billion in new mortgages each year. So this, whereas reverse mortgages kind of used to be a bit of a niche product, this is no longer a niche product. Demographics are changing, needs of people are changing, and we're just writing more and more reverse mortgages. We're just seeing so much bigger a need for it now. So it's worth learning about. So what is exactly a reverse mortgage? Well, the good news is it's relatively simple. Like I said before, we are a Schedule I bank. Our mortgage product itself is really exactly the same product as if you were to walk into BMO or TD or Scotiabank and ask for a regular mortgage against your house, with two main differences. The first one is that we don't qualify our clients based on their ability to make payments or their debt servicing ratios, as they're called in the industry. So normally, if you were to ask for a mortgage, you'd go in and the first thing they'd say is, how much money do you make? And they'd say, here's how much we can qualify you for. We don't do that. It's strictly based on your age and the value of your home. And I'll get more into that in a moment. And then the second major difference is no payments are required. So I like to say payments are optional because you can make payments if you want to on this mortgage. But like I said before, in my 8 years, I've had a grand total of 4 clients set up regular monthly interest payments. And one of them swiftly canceled because she said, this is ridiculous. This is totally not the point of this mortgage. So really, basically, it's a payment optional mortgage against the value of your home. It's at a relatively low loan to value. So I said before that it's age based. And so what that means is the youngest that we will lend to is 55 years old. And there's no maximum age, as old as you want. The maximum loan to value that we will lend, when I say loan to value, the percentage of the value of your home that we'll lend you is 55%. So in that case, that on $1 million home would be $550,000. But it's age-based. The older you are, the more we will lend you, up to a maximum of 55%. So a 55-year-old will probably only get about 20% of the value of their home. Our average client is around 73 years old, and our average loan to value across the country is around 33% loan to value, so a third of the value of the home. To get 55% of the value of your home, you need to be in your 80s. Okay, and the reason for that is because you're not making payments. There's the interest on the mortgage is going to grow over time. Now, I'll show later how that's very well offset by the growth in the value of your home. But we don't want you to run out of equity. You don't want to run out of equity. Nobody wants you to run out of equity. So we're very conservative on the loan to values that we lend. It's a very safe product, to be perfectly frank. But that's how it works. So payments are not required on this, which is lovely. Proceeds are tax free. So one of the big questions we get is, look, if I'm getting a guaranteed income supplement from my OAS and CPP. I get a little bit more, and if I make more money, I'm going to lose government benefits. The good news here is that won't happen. The proceeds are tax free. It's essentially just a loan or a mortgage against your house, and so you can use the funds however you want. You don't pay tax on it, and then you only repay the loan when you leave your home. So whether you choose to move down the road or whether you stay in it until you're carried out of there, you never have to repay us at all. As long as you keep your property taxes up to date. And the home is insured and you actually live in it as your primary residence. So 6 months plus a day every year, then you never have to pay us. You never have to make a mortgage payment. You eventually will have to pay us back when you leave the home, but it might not be you that has to pay us back. So now we have something called the fair market value guarantee, and I'll get into that a little bit more later. But it basically, in the worst case scenario, if nobody wants to live on Vancouver Island or wherever you're watching this from, and interest rates go up to 25% and the mortgage goes underwater. So your home is not worth very much, but your mortgage is worth a lot. The good news is that's our problem, not yours. You can never owe us more than the fair market value of your home. And if that did happen, the advice would be just stay living in your home for as long as you can. You'll never have to make a payment. You won't have to pay us rent. All you do is pay your property taxes and keep the home insured, and you can stay in the home forever. So the good news is we're pretty good with our numbers, and it just doesn't happen. So it's the actual fair market value guarantee is written into our contracts, and it's a legal obligation on our part, but it just doesn't get used, luckily. So that's very good. Okay, let's go to the next slide. Okay, so why are we so popular right now? We are growing very fast. So again, as I said before, it's a lifetime loan secured against the equity in your home. So should you be approved for, decide that you want to get approved for a home equity bank chip reverse mortgage, we would lend you the money now. In a hypothetical situation, let's just say you had $1 million home and you were approved for $300,000, but let's say you only needed $200,000 of it right now. We could give you the $200,000. You never have to make a payment on that. For as long as you live in the home, you have access to that other the other $100,000, and you can draw on that whenever you want to, but you don't need to, and you won't pay interest on what you don't take. The amount that you do take, interest accrues over time, but you never have to make a payment on that. Okay, for as long as you stay in the home. Okay, again, up to 55% of the home's value tax-free. We don't care about your income. It doesn't matter. This is purely an equity lending product. And as we said before, I think we covered off much of this. So no negative equity guarantee, and it is a tax-free money that comes to you. So, okay.
I got one question for you, Mark, on the
Sure.
no negative equity guarantee, just so people really understand it. So how you said that your mortgage goes underwater, you don't owe any more than that. That's the same if you had any assets in another bank account for, say, investment income. You guys aren't able to come after any of that stuff as well.
Right. That's a very good question. Thank you. Yeah, we're what's not known as a non-recourse lender. So we cannot actually go after other assets of yours. The only security that we take is your home. And again, the home is just a mortgage against your home. So the title of the home always stays in the client's name. And it's, we put a mortgage on that. And the only thing that we can ever collect on is the value of the home. And so should the worst happen and we needed to go after the value of that home, it depends on the fair market value of the time of the disposition of the home. It just depends how much the home would sell for, or whatever way it was settled. We would ask for the value of our mortgage back. But if the sale of the home didn't cover that, then we can only get it's actually the sale of the home's value minus any legal costs.
Yeah.
So,
and that's just for anyone else to know, with other mortgages, it has the recourse where they are able to come after all assets and anything. And I think that is a big thing that a lot of people don't realize with the reverse mortgages. And we know it's not going to happen. And like Mark said, they have it built into their redundancies, but it's still something to keep in the back of your head.
Mm-hmm. And I actually believe there's a couple other reverse mortgage companies in Canada, and I'm not sure that they have the same clauses. I can't say 100%. But it is actually pretty rare for a mortgage lender to be considered a non-recourse lender. And so it's just another level of security that, again, is probably virtually useless, because our loan to values are so conservative, and it's just the likelihood of ever needing to go into that situation is so unbelievably low. But you know what? It's a nice safety blanket to have, for sure. Yeah. So, the chip reverse mortgage has been around for a long time, and the good news is the conceptions are changing over time. When I started 8 years ago, it was I came into a territory that not many people had heard about it before, and it was a bit of an uphill battle educating the people that send me the business, and never mind the clients that I met. There are a lot of misconceptions, many of which come from the business that happens down in the United States. We all know there's a great media spillover across the border. If you were to, Google reverse mortgage, a lot of the stuff that comes up is based on what happens in the States. And there's certainly a lot of horror stories. Some of the things that we hear about also come from, when we started in 1986, there were several other reverse mortgage lenders in Canada. All of them were private lenders. So a private lender basically matches up an investor who wants to get a really good return on their investments using real estate secured investments, basically like selling mortgages. Those are usually riskier mortgages, so they're usually much higher rates. And so I've heard of times when our rates were 13 to 15%, that sort of thing. And there was a lot of other people doing that. There was annual renewal fees, and it really wasn't a great long-term product to begin with. Down in the States, there are companies that will actually, they're actually life insurance companies that call themselves reverse mortgage lenders, and they will give you an annuity. So they'll look at your health, they'll look at your age, they'll look at the value of your house, and they'll run the scenario based on the likelihood of how long you're going to be alive, and they'll guarantee you a monthly income for as long as you live in the house, but you sign the house over to the company. So those are some of the misconceptions that sort of form like what is a chip reverse mortgage. Even if we wanted to take the title of somebody's home in Canada, even if we thought that was good business practice, our regulators probably wouldn't like it. So we'll go through some of these things here. So it's a product designed for people with a lot of debt. Now, probably 60% of the mortgage or the business that we do is swapping debt that requires payments for debt that doesn't require payments. So somebody has reached retirement and for some reason they have a mortgage, or they have gotten into debt some way, medical expenses, helping families. There's hundreds of reasons that we hear of all the time. And they're retired now, they're on a fixed income. Inflation is getting really difficult to keep up with, and they're struggling to make payments. And so basically we're taking that mortgage that they already have, or that debt they already have that requires monthly payments, and we're paying it out using our mortgage, which doesn't require monthly payments. So it's a cash flow play, which is, if you want to stay in your home and you're struggling with cash flow, there's a great solution. You can still make payments to us if you want to. Right now our rates are actually lower than a bank HELOC, home equity line of credit. So one of those, well, that gets us to point number 2 there. Reverse mortgages are expensive. They certainly have been in the past. I mentioned what they used to be, 13 to 15%. Right now, like I said, our rates are lower than if you were to go into the bank and ask for a secured line of credit against your home. So, yeah, they're not expensive. The setup fees are, pretty similar to a regular mortgage setup fee. And with ours, it's a one-time setup fee.
Yeah, exactly. That's what I was going to say, Mark. Once it's quite a bit different than a mortgage where you have terms and stuff, where once you register, it's you're good to go after that. Yep.
Yeah, exactly. One-time setup fee. And then for as long as you live in the home, you never have to pay another setup fee again. So that's really good. Reverse mortgage is the same as a HELOC or conventional. Well, I mean, technically it is a conventional mortgage with just a few different features, namely the qualification requirements and the fact that you don't have to make payments. A HELOC, which is a home equity line of credit, we like to use acronyms in the mortgage industry. Basically it's considered a revolving line of credit, meaning you can borrow and pay back and then borrow again. With this, you can't do that. We can approve you for a large amount, or whatever amount we might approve you. You could take part of that and then have access to the rest later, but it's not re-advanceable. So you can't advance and then pay back and then advance and pay back forever and ever. So it's a little bit different there. I think, Alex, did that explanation make sense?
Yeah, totally.
Okay.
Yeah,
Okay.
You can't borrow the money again. Like with a HELOC, as the equity in the home is built up, people are able to borrow more and more. In this case, they can't. But in the next slide, we'll talk about how it still saves money for people down the road.
Mm-hmm. Yeah, exactly. So, and again, in our case, the main difference here is that no payments are required. So
yeah.
The bank will own or take my home. I think I talked about that a little bit a minute ago. It happens in other countries. It doesn't happen here. Our regulators don't want us stealing people's homes. And even if we thought that was a good idea, it really is just a mortgage. We'll lend you money. We take your home as security, but it's just a mortgage written against your house. When you're done with the money, you pay us back. The house always stays in your name. So that's pretty simple. It's just a myth. And a reverse mortgage will eat away at all the equity in my home. Now, this probably is the most important, most logical, misconception, or I guess maybe not a misconception, but the most common concern about a reverse mortgage is that if I'm not making payments on my mortgage, what's going to happen to all the equity in my home? And I think that's a very, very important point about reverse mortgages that we need to go into detail about. And so let's flip to the next slide. Excuse me. So I said a little bit earlier that we're a very conservative lender. Our average loan to value is 33% across the country, and the maximum we'll ever go to is 55% of the value of your home. And now this slide there's a lot of numbers and colors and things like that. And so the dark gray bit across the bottom is the initial advance of the mortgage. So in this case, what we have here is a home that the client's age is 73 years old in this illustration. They have an $800,000 home. And for this illustration purpose, that home is going to grow at 3% per year, which depending on what market you're in is very, very conservative. I'm in Victoria, and our 60-year growth rate is 6.24% at the end of 2022. So 3% is very conservative. They are taking a $300,000 mortgage, which at the time of advance leaves them with $500,000 in equity remaining. $800,000 home minus the $300,000 mortgage leaves the client $500,000 of equity. Okay. Now, what the illustration shows, the lighter gray part is the interest that's accruing over time on this mortgage. Okay. And so as you can see, and then the green box is that home growing from $800,000 at 3% per year. And over 20 years, the value of that home ends up at $1.444 million. The mortgage balance has grown substantially as well. As you can see, it's more than doubled over that time. It's grown to $869,000. But the important part is that the clients actually have more equity than they started with, $575,000. And in 20 years, they've never made a payment. So for whatever reason, at 73 years old, they needed to borrow $300,000. So maybe they were faced with some cash flow issues, and they were thinking maybe they have to downsize, or maybe they're going to have to sell their home, move to a community they don't know. Who knows what the situation was? I've had plenty of clients over the years that I've helped out of foreclosures where they literally were going to be legally kicked out of their home because they couldn't pay the bank. And we've been able to take them out of foreclosure. And so they've been able to stay in the home. And in this illustration, they stay in the home for 20 more years, and they have more equity than they started with. Okay. And these are real numbers, just to just to be sure. And really, it's just the power of compounding interest in that you have an $800,000 asset, and even though it's growing only at 3%, I think the mortgage in this situation was growing at 5.75%. That's not written on the actual slide, but it is in the notes on this presentation. So you have a house growing at 3%, a mortgage growing at a higher percent, 5.75%. And in 20 years, the equity has still grown over time. So that I hope illustrates the way these work really. As rates change and as assumptions for housing price increases change, we change our underwriting guidelines so that in this case here we've lent about 36% loan to value on that house. If rates were to go higher than the 5.75 in this illustration, that 73-year-old would qualify for a little bit less. As is the case currently. So right now, our 5-year rates are they're under 7%. They're in the high sixes. And so right now, a 73-year-old would probably qualify for about 30% loan to value. And that's so that they can stay in their home for 20 years and not lose their equity.
And this same differs for location, like say someone that was living up in Port Hardy compared to Victoria, because we know that the assumptions for growth rate is different. They're going to be able to borrow more money that way as well.
Yeah, exactly. We have basically different postal codes and locations all across the country are categorized into different, we have A, B, C, D, E locations, and each of those, obviously the A's will lend the higher loan to values at the same age, just because, proven growth rate over time, proven marketability, and then you get to, some places in northern Saskatchewan where it's just, if there's not likely going to be major growth. Nothing wrong with North Saskatchewan, but it's just not a highly marketable area. So
But that just goes to show the conservative approach that home equity is taking, and showing people that it's not something that people are just lending money and hoping that they make money off of it. It's showing that this is at a very conservative approach, because we want to make sure people still can live in their home and not be underwater by the time they actually get out of their home.
Right, exactly. And you know, I mean, I'm not going to try and pull the wool over anyone's eyes. We don't like risk. We're a bank. We don't like risk, and no bank does. And we do it as much to protect ourselves as we do for our clients, right? We want to make sure that a client isn't going to run out of equity, because if they do, there's that no negative equity guarantee, and we're taking the loss on that. So it works just as well for us as it does for our clients, to be perfectly frank.
Exactly. Well,
Yeah.
here we'll get into the different types of products.
Yeah. So we have 4 products, and 2 of them are virtually the same thing. But a regular product is the chip reverse mortgage, and it's designed as essentially a lump sum product. So earlier I talked about, some people might have the need where they have an existing mortgage that they just need to, swap for one that doesn't require payments. And in this case, this is our traditional product. This is a lump sum. So, somebody qualifies for $300,000. They can take a large lump sum. They can take as little as $25,000, but generally people are paying off some other things, or they have some use for the funds. They're going to help family. They're going to maybe have some medical expenses, or, want to go and book a trip of a lifetime, cruise around the world, things like that, renovations. Look, there's some things there, paying off stressful debt, buying a second home. Look, the slide's telling me what I need to say. So yeah, that's our traditional product, is the chip reverse mortgage. So with that one, like I said, it's designed as a lump sum. You can take as little as $25,000 or up to the full amount that you qualify for. Never have to make a payment. Okay, now skip over to the right a couple, and there's the chip max. In certain locations, so really our major urban centers, we can basically squeeze out a little bit of extra funds, but it's considered by our regulators to be an exception to our standard underwriting guidelines, and therefore it has to be risk-based priced. So there's without getting too into some of the guidelines and things like that, it's a higher loan to value in a less susceptible market, but the regulators deem it an exception. And so we add a little bit higher rate. It's usually around another 1% onto 1 to 1.25% on top of the regular chip. So it's essentially the same product with just a higher loan to value for a higher rate. The income advantage product is an interesting one. And really what that's for is for somebody who doesn't necessarily need a big lump sum injection of cash, but needs a little bit of extra cash flow every single month. So this one, you only actually need to take a $20,000 initial advance. Now, again, you can take more if you qualify for it. But really what it's set up for is so that every single month there'll be an amount put right into your bank account that's basically, off of your mortgage. And so in this case, if you were approved for, say, $300,000, you could take as little as $1,000 each month, and you would continue getting that for, in that case, 300 months, $1,000 a month for 300 months. So most people tend to take a little bit more. But where this is great is, again, inflation lately has been taking a chunk out of everybody's retirement income. And this is a fantastic way to use your home if you don't need a big lump sum out of it. If you have, say, a free and clear home, or one that doesn't have a lot of debt against it, you can use that to pay you a salary, to pay your living expenses while you continue living in there. And the great thing about this is that you're only paying interest on each draw. So if you're only taking $1,000 or $2,000 every single month, you're only paying interest on what you've actually drawn on. So the interest accrues a lot slower than if you took a big lump sum at the start. This is also an interesting one right now because investment values have been down for quite a while now. And I've done several of these where I've spoken with clients and they've said, look, I don't like taking money out of my investments when they're down so much, because then as I draw out of that, I'm drawing a higher percentage of my investment values. And when the rebound comes, I'm going to have way less in there. So I've been scrimping and saving and eating cat food so that I don't have to spend all my money. why not take a couple $1,000s out of the value of your home and live off of that? Stop taking income from investments for now. And then when the investments come back, you can start taking the income as you initially planned to, and then stop taking income from your home. Did that make sense?
Yeah, that is a
Okay.
great one.
Okay.
And the other one I was going to talk about is people like deferring. We've had clients that will defer CPP. Obviously, if you take it at 65, you're going to get X amount. But if people are able to actually defer it to 70, in the long run, you will actually get more money. But obviously, you want to make sure you don't want to stop living your life like eating cat food. You want to make sure you still get to enjoy your life at the same time. And that's a big thing. And everyone's based off of, usually like for investments, is taking 4% off every year, and you never should be losing that money. But obviously when stocks are down 20 or 30%, taking that amount of money is actually really going to hurt you. And where you can tap into the equity of your home, it's just going to help boost it. And at the end, if you say, hey, I don't need that, investments come back up, you stop taking that monthly income.
Yeah. So a few things to say about that. I had a great client story not long ago, just back in the summer with this Income Advantage product, and it was exactly that story. Had lived in the house for 20 years, really wanted to stay there. There was a little bit of deferred maintenance that needed to be done. These clients had to get rid of their housekeepers and their gardeners because they didn't want to take income from their investments that were down so much. And in talking through things with them, they also needed a new heat pump and they needed a new car. One of their cars had just given in. So they had a pretty nice house. And what we did for them was basically set it up. They took $100,000 initial advance, got themselves a new heat pump and a used little tiny one of those little BMW electric cars, a used one. So that was $100,000 for the heat pump and the car. And then they brought back their gardener, taking $3,000 a month out of the value of their home. They brought back their gardeners and their house cleaners, and they're happy. They're really happy. I got a call from them a couple of months ago after they'd been, getting a few months of the monthly advances, and they were very, very happy. So, but again, once their investments bounce back, they'll stop drawing off the value of their home. Their home will continue growing in value. With very little mortgage balance against it, and they never have to make a payment on that, and they can live off their investments like they'd planned to. So, and in the future, if their investments were to go down again, they could just start drawing from us, because as long as they live in that home, they'll have access to the money they were approved for. Literally, all they have to do is call us up and say, hey, we'd like to start taking monthly income from you again, or a lump sum if they want to. If they needed a new roof or something like that, they could access that for as long as they lived in the home. We never take that away from them.
Here's a question for you, Mark, that had my brain thinking. So say if, obviously, as the values of homes do go up, say if these clients, the ones that you had, for 3 years, they were taking that money, and then for 5, they were like, okay, you know what? I need to stop. My investments are good. The value of the home has actually gone up. That loan to value has stayed down lower. If they reset up with you guys, there'd obviously be another fee charge probably, but would they actually be able to access more equity then?
Yeah. And in fact, last year we had an unbelievable amount of refinances because the home appreciation was so substantial over the last couple of years. People came back and they said, you know what, I can access more money. This makes sense. I want to stay in my home. I want to enjoy my life. I'm sick of, hunkering down inside with COVID. I want to get out and do stuff. Give me some more money. So
yes.
And then we're still seeing that. We've had a lot of refinances. So yeah, absolutely.
The thing I want to say for people on this, obviously you can see like this money isn't free. No one's just giving money out for free, but if to actually enjoy your life, I've spoken with my parents myself, and they have equity in their properties, and like, oh, well, Alex, I don't want to use it because I'm going to want to sell it and give it to you. I know, Mark, we're going to get into that a little bit later about living inheritance and stuff. But I've told them, why would you stop living your life? They told me before, hey, I'm only going to be traveling till I'm about 80. I'm like, you're going to be traveling a lot longer than that. And their plans were set up 20 years ago for their retirement, and life has changed since then. And I do think people need to readjust to that now.
Hmm. That's a really good point. So I was saying earlier, I used to be in financial planning and investments, and there was something that always bothered me about how a traditional financial plan worked, and that was, that basically you would work until you were 65 years old. You'd start taking your government benefits. You would have squirreled away a whole bunch of money in RSPs, and then you would start drawing down your investments. And you're supposed to be living your golden years and traveling and doing all these great things, but if you wanted to have a good lifestyle, that money was really only going to last you 15 years kind of thing. And then at some point you had to sell your home, and the funds from the sale of your home basically had to make it so that you could live out the rest of your days in a lot of cases in poverty. Because I mean, look at rent right now. It's insane, right?
Yeah.
And so, downsizing is, again, I'm going to talk, I'm going to put it off until the slide. So we'll talk a little bit about right sizing versus downsizing, but we'll finish up with the products here. So the chip open, this is an interesting one because a lot of times, really what it's used most for is for moving. So purchasing a new property where a client doesn't have 100% of the money. And so what we can do is if you have a property now, and you want to move. A lot of the clients in our demographic that we lend to don't want to have to line up the purchase and sale dates. In a lot of cases, we have clients who have lived in homes for 3 decades or more, and they would like to purchase a new home, move, take a little bit of time to clean out, go through those memories, see what they can throw away, get rid of some furniture, whatever it is, clean out the old home and then list it. Okay. They don't want to be having to gather all their stuff up and get into their new house in the same day. And so what we can do is it's called an inter alia mortgage. So we put a mortgage over both properties, on the value of both properties, on one mortgage. It's a totally open mortgage, can be paid out penalty free at any time. And that gives somebody time to purchase the new property using borrowed money from both properties. And then when they're ready, they sell the old property and pay off the whole mortgage. Okay. And because of our low loan to values, generally the sale of the old property is more than enough to pay out the whole mortgage. You don't have to pay out the whole mortgage. You could keep some of it based on the value of the new home, but it's a very useful product. That's been its most useful purpose, but it's a short-term open reverse mortgage. So it's a short-term mortgage that doesn't require payments.
Yeah, and that's like obviously in banks and stuff where we have bridge financing options, but lots of banks require some type of income to be able to still qualify for it. Where in this case with the chip open, there is going to be no income qualification. And that's the big difference.
Yeah. In banking, generally, you only qualify for bridge financing if you don't need it.
Yeah.
So, and bridge financing is when you have a sale of one home and a purchase. This, you don't even actually need to have a sale contract on your own home. You can just
that's a big one. Any other bank, you have to have a firm sale on both sides to even get
right.
Or you're going to private, and that's where we get the fears and the costs from.
Right, exactly, because that's much more expensive. In terms of rate, it's comparable, but in terms of the setup fees, we're considerably less expensive on that side. So, okay, so that's the overview of products. Again, if there's questions, people can reach out to either of us and ask. So, what do people do with these things? They get a reverse mortgage. What do they do with it? Okay, skip to the second one there, debt optimization. That is, like I said before, that's probably about 60% of our business, is swapping debt that requires payments for debt that doesn't require payments. In those, like I said, about 60% of our business, we see people that have mortgages, loans, lines of credit, car payments, credit cards, private loans, all sorts of things. And in some cases, it can be shocking to see the long list of credit cards, and people are having to make payments every single month on all of these things. And when you're retired on a fixed income, that can be pretty challenging. And so when we say debt optimization, it's just like I keep saying, swapping debt that requires payment for debt that doesn't require payments. And in so many cases, our rates, especially right now, I think our rates are high, but relative to everything else on the spectrum, conventional mortgages are maybe a little bit lower if you're locking in at a good rate. HELOCs are more expensive. Those used to be pretty much the best rates. A home equity line of credit, they're more expensive than us. Credit cards, way more expensive. Car loans, personal lines of credit, everything is more expensive. So I haven't always been able to say that, but at least at this point, we're kind of like the second lowest cost option. So if you qualify for enough. So right sizing. This is what I was talking about before. I mean, again, with the financial plan, so many people are they get to a point and they say, okay, it's time to downsize, sell our home, and live off that money for the rest of our lives. Or in some cases, people just get to a point, whether they've planned to or not, and they feel that they can't afford to live in this home, but they really, really want to. And so somebody might be considering downsizing. What I would like to propose, or for people to consider, is what is the cost of downsizing from your home? So there's the financial cost and then the cost to your lifestyle. So first of all, the financial cost. Well, right off the bat, selling an average home, we're here on Vancouver Island, selling an average home anywhere on the island is going to cost you probably $50,000 to $60,000 just in fees. So that's money that's gone. You're not getting that back. That's in realtor fees, legal fees, moving fees, cleaning fees. What else do you have to do? Things that you have to do to make the home that you're moving into work for you. That's very expensive. And I could probably keep you in most, on our average size mortgage, I could probably keep you in your home for 15 more years, well, maybe not 15, but for another 10 years based on $50,000. So that's a big consideration. But then also you have to consider the cost of moving out of the home that you've lived in and you love. Your neighbors, that if something goes wrong, they'll help you. They'll take your garbage out for you. They'll mow your lawn. If they don't see you for a few days, they might come and knock on your door and wonder what's happening. You've got doctors and dentists and bankers and the grocery store people that you see all the time. If you're going to downsize, chances are you're going to have to move to a different community because realistically, think about where you are right now. And if you were to downsize, would you be able to go to a smaller home and make it affordable in your same community? Are there condos near you that you could move into that might be a little bit cheaper to buy, but then you're looking at monthly maintenance fees? Those are real considerations that the whole approach to downsizing doesn't really seem to take into account. So again, maybe not for everybody, but I just think it's certainly a good to be part of the conversation for sure. Something that we've seen now, again, when I started back 8 years ago, most of what we were doing was needs based in that debt optimization category. And really what we've seen is a major shift over several years to people using the equity in their homes to help younger generations get into homes. Because, we all know this, it's like, if you're not already in the market, it's really, really difficult to get into. Even a 5% down payment on a single family dwelling is still a significant amount of money. So we're seeing people take out, parents and grandparents take out of their homes, which would, be basically considered an early inheritance or a living inheritance. They take the money out of the asset that would eventually be gifted to the kids or grandchildren anyway, and they get to help the kids get into the home now, and live through, the joy of seeing them do that and move into their home. And then there's also an argument that could be made that then the whole family has a bigger asset base that's growing for them, based on some borrowed funds, and the long-term effects of that are better, but that's too deep an argument for today. So
I think just the biggest thing is, like, I know myself, I have one son, I have another one here due in March, and I know I'd rather be giving my funds at some point when I don't need them. I don't plan on giving them everything, but if I can help them and watch them enjoy it, that's a big difference. Where obviously a lot of people want their kids to get it on their own, but it's so hard now. That's the different story.
Mm-hmm. Yeah. And how long do you wait? Do you, if you're planning to live in your home for, another 10 or 15 years, and you've got, your kids or grandkids are struggling to get into the market, and the home that you're living in is the value of that is going to eventually go to them anyway. Why not consider early inheritance? And again, that's something that we've been doing a lot of these days, and it seems to me that it's really rewarding for the people who have done it. So, Other uses, pretty common, healthcare. Obviously, sometimes health issues can get very expensive, and we can. In fact, we're talking about launching a different product that's called Chip Health that will have a few different features, and so that's it. It's that prominent. It's that common of a use that we're considering building a whole product around it. And then we talked about the bridge financing before, so getting into a new home and using the value of both to finance it. So.
Perfect. I know we're kind of going over the same stuff here again. I'll just go through all of them, and Mark, you can just break it down for everyone. But we definitely did talk about a lot of this previously.
Yeah, I don't think there's any new information on this slide. Not sure how we included both of them, but at least the last one looked nicer than this one.
Yeah, for sure. Yeah, we got all the stuff in there, and there's lots of different options. I find the product is very open. It's not, hey, you only have to use it for this amount. I know you guys have other strategies like for talking about sizing and stuff, like with that inter alia that you were talking about, how some people are actually able to buy a place now. They'll actually be able to rent it out because they know that they are going to want to get into that, but they want to buy it at today's price, not 10 years from now. Mm-hmm. And there's lots of different other avenues for people to think about.
Yeah, you're right. I've seen that very commonly where someone has said, look, this is the place that I eventually want to move into. I'm not ready yet, but it's on the market and I want to get it now. So yeah, they can do an inter alia, whether it's the open product or whether it's one of our longer term products. We can still do inter alia. We can actually do inter alia over any number of properties as long as somebody owns them all, and as long as the primary residence is one of them. But yeah, we can do that for sure.
Well, we've made it to the end for everyone here. So like I said, if anyone does have any questions, you're going to get an email after this. That's going to have my information, Mark's information. So you can take it down now, but please reach out to us anytime. And then if we do have any other questions, we'll kind of answer them here now. I do know a couple people had asked me some to hit Mark with that are a little bit heavy hitting that I think some people will want to know. So I'll kind of open the first one. The big one is, what happens if a client dies with a reverse mortgage?
Right. Yeah, that is a very good question. So there's a couple of different sort of situations. It can be a single client who dies, or it could be a couple, a married couple that have a reverse mortgage, and then it could be the first of them to die or the last of them. So I'll start with a single client. So single client living in a home has a reverse mortgage, they die. Any penalties that would otherwise be assessed are completely waived. It would be seen probably as predatory if we were to collect penalties from mortgages of people who die. And effectively, we ask for payback within 6 months, but we know that sometimes probate can take a little bit longer. And what happens to the home or the value of the home is basically up to the will or the estate of the deceased client. So, generally the home will have been left to somebody, say a child or children in the will. And it's up to them how they want to deal with the home, whether they sell the home or whether one of them moves into it. One way or another, we just ask that the mortgage is paid off, or in some cases can be assumed or paid off by another chip if the person moving into the home qualifies. But really, it's just the same as any other mortgage. The borrower dies and the lender wants to be paid back. We just know that in a lot of cases, it can take a little longer. Our guidelines say 6 months we'd like to be paid back. But I've seen it take longer in some markets where, sales can take a little bit longer. Then yeah, it can take a little bit longer to do that. So it's okay.
This is where I really think like how you said you used to work in the financial world, where everyone really needs to come together for forward planning. A big thing is some people, they want to give their home to their family. So say if my son really wants to grow up into my house, these are the type of conversations family members need to be having with each other. Obviously, if I just go and take on a bunch of debt on my home, I want to do that. But if my son had planned on living in it, we want to make sure we're planning for that, because for him to obviously take over that home, he's going to have to pay that off. And that's the different scenarios. But if I plan in my head, hey, you know what? I'm going to need 200,000 at some point. It's going to grow up to be 400,000, but he's going to get a home that's worth $2 million. And at that point, he only has to get a $400,000 mortgage with a conventional person at a bank, or he has the money now himself to put the down on it. But those are the forward planning I think people really need to start having as they get further into their life.
For sure. And then the other scenario is if it's a couple. So when we have somebody who's in a matrimonial style arrangement living in a home together, we'll ask that both of them go on the mortgage. And the reason for that is that when the first one, if the first one dies, if one of them dies, we're not calling them up and saying, look, we're really sorry, Mrs. Widow, that your husband has just passed, or Mr. Widower, that your wife has just passed, but you weren't on the mortgage. It's time to pay up. It's not a nice situation to be in. And so we ask that both are on there. If one borrower dies, nothing happens. The mortgage just continues. You can worry about grieving and other things. So.
Here, this is a question that actually just came to my head on that. Obviously, you have to be 55 to get on to be able to even get a CHIP mortgage. Say if you have one partner that's say 55 or 60, but your other partner is actually younger than that. How does that lay out for it?
Can't do it. If if it's a matrimonial style relationship, we need both of them on the mortgage. If one's younger, we can't do it. There's certain lending guidelines that we've set up, and then we're held to by the regulators, and that's one of them. We've considered bringing it down, but to be honest, the loan to value would have to be so low for someone who's under 55 years old that it wouldn't be worth it. Yeah.
I mean, I know you brought up how there was some other companies, and I'm not going to bring up the other company's name. There was a lender out there last year that was lending money to all ages based on loan to values. Their rates were higher, but they didn't have the no negative equity clause, and they fully run out of funds. They're not operational anymore, and that is the fear. What's going to happen for those clients down the road? Where people don't have to have that same fear with CHIP, a company that's been around for a long time and has shown a proven track record.
Mm-hmm. Yeah. It's also that experience as well as it's very helpful in determining our loan to values, because we've got 37 years of history to draw on. So we can map out exactly what we should be lending with a great degree of accuracy.
And we got one more here. So this is for people that, again, kind of forward planning, is if they have a power of attorney set up, can I help my parents actually set the property up?
Mm-hmm. Yeah, we deal with that quite often, actually. So if for whatever reason, somebody, a child or grandchild has power of attorney over the homeowner and wants to help them set up a reverse mortgage, then certainly we can act through the power of attorney. On the condition that we confirm using independent legal advice at closing that the funds are for the benefit of the actual homeowner and not for the power of attorney. So
yeah, for sure. Yeah. Well, you can't just be stealing money from people.
No, we don't want to get into that sort of situation at all.
No, exactly. Well, I think that's going to be it, everyone. Like we said, please send us a message anytime. We're really here to try and help people, even if it doesn't work, that this product's not going to work for you. Mark and myself are always willing to help try and plan for your future and make sure you're setting yourself up for the best success and the life you want to live. We all know everyone works hard every day, and you don't want to be not enjoying that life in retirement. Awesome, Mark. Well, thank you very much.